Before we get started, just want to give you a little background on myself for those of you who have not met me before. My name, of course, is John Vento. I'm a certified public accountant. I'm also the president of Comprehensive Wealth Management, a New York City-based CPA firm as well that specializes in working with dentists across the country. I'm insurance licensed, I'm securities licensed, pretty much anything investment, tax, accounting related. If it's financial related, I got you covered. Throughout this presentation, I'm going to encourage each of you to take notes. Note down what your question is so that you'll have an opportunity to reach out to me and speak with me about what your particular question was. Please call my office. Contact information is at the bottom of the slide. And now we're going to jump into another part of our presentation. So the next strategy, advanced strategy number 6, is utilizing a combined 401k profit sharing cash balance plan. That was a mouthful, but I'm going to explain it to you in a minute. So if you're an older dentist with younger employees, you may be able to maximize your tax deductible retirement plan contributions by hundreds of thousands of dollars. That's right, hundreds of thousands of dollars each year through a combined 401k safe harbor profit sharing with a cash balance defined benefit plan. So what does all that mean? Well, let me give you an example. Let's assume you're a 62-year-old dentist and you may be able to contribute up to $63,500 to a 401k profit sharing plan. That includes the $6,500 catch-up provision, which would be phenomenal. But if you also have a cash balance plan, you may be able to add another $300,000 to this defined benefit cash balance plan and get this huge upfront tax deduction. If you are an older dentist who did not do a good job of saving for retirement, this is a great way to play catch up. So what do we mean by this? Well, if you listened to one of my previous lectures, you found out the secret of how to accumulate wealth. And the secret to accumulating wealth is you have to start early and you have to try to make as much money on your investment within your risk tolerance. And then with compounding over time, you'll definitely accumulate wealth. In the first lecture that I give, the roadmap to financial independence, I show the listener how they could accumulate millions and millions of dollars. Time has to be on your side to utilize that strategy. Unfortunately, for some of you that may be older and didn't do a good job of saving before, right now you may be sweating it out saying, am I ever going to be able to afford to retire? Well, if your practice is doing really well and you don't need all of the income that's coming in from your practice, then utilizing a cash balance plan is going to be a great way for you to play catch up, because you could literally put away hundreds of thousands of dollars every year into this cash balance plan, and that'll get you to $2 million, $3 million or so within a reasonable number of years. So there is a way to make up for lost time, and that's what a cash balance should be able to do for you, along with a lot of other good things. So let's talk about how that would work. So let's give this example here. Let's assume that you're a dentist. Let's also assume your spouse works for you and you have 4 employees that are in your practice. With the chart that I have up here, we're assuming that you're 55 years old, your spouse is 53, and then you have, like I said, 4 other employees that are younger with varying ages. So focusing on this chart for a minute, assuming your salary is $285,000 or more, clearly you're going to qualify for the $63,500 401k profit sharing contribution. Your spouse, based on a $60,000 income, would qualify for $29,600. Your employees could do salary deferrals of their own. That comes out of their own paycheck. We're not going to count that into this example. But you, as the employer, through the profit sharing, let's assume when you go through the actuary, you're required to contribute 6% of their salary. That's what it would cost you. In the example I'm giving you here, the employee who's 20 years old, as you notice, there's no dollar amount associated with them because one of the rules with these plans is that you could specifically exclude certain employees. So if your employee is under the age of 21, they do not have to participate. The other thing is if you have relatively new employees that have not been with you for more than a year, you don't have to contribute to them. And if you have employees that have never worked 1,000 hours or more in your practice, they typically are part-timers that have never worked more than 1,000 hours, they could be excluded from the plan altogether as well. So the cash balance contribution portion, because it's based on not a contribution limit, but it's based on what we call a defined benefit plan, where we have to calculate what amount do you need to accumulate by a certain age so that you can get a certain benefit during your retirement years. Well, the plan actuaries go through this, very complex how they do it, but in the example I'm giving you, this particular dentist was able to put away $240,000 in a retirement plan for themselves, did another $1,200 for the spouse, and then $800, $600, and $500 to the other three employees that qualified. So at the end of the day here, the employer made contributions of $341,900. That translates to, in a 50% tax bracket, I think that's about $170,000 or so. That is a significant tax savings. In this example, the dentist, along with the family members, they received 98% of the benefit by implementing the strategy. This is a no-brainer. If you fall in this category, this is a must-do. Some dentists, depending on their age and the age of their employees, the numbers don't come out quite as good. If you're getting at least 75, 80% of the benefit to you and your family, I would encourage you to take advantage of this strategy. A few other things that I want to mention about these plans is that the profit sharing and cash balance component of it, there's a vesting schedule. So what does that mean? Well, with the profit sharing plan, it could be set up so there could be a 6-year vesting period, which basically means that if you have an employee who qualifies and now you put money aside for that employee, if they don't remain with you for 2 years, when they leave, they walk away with none of that profit sharing. After 3 years, they get 20%. The next year, it'll be 40, 60, 80, and then 100. So if they stick around for 7 years and then they leave, they could take the benefit with them. If they leave early, that money goes back to the practice, which is a terrific thing. Similar thing with the cash balance plan, but typically it's called a cliff vesting. The first 2 years, they're not entitled to it, even though you set the money aside. If they leave with nothing. After the 2-year period is over, then it becomes fully vested at that point for your employee. So the reason I like having those vesting periods in there is because you want to reward your loyal employees. Plus, you want to give them any reason you can, especially if they're good employees, to stick around. If you're providing them with an 8% benefit, as I'm explaining in this situation here, employees will tend to be a lot more loyal to you if they know you have their best interest in mind. So utilizing this approach will help you retain more employees and also generate a tremendous tax break to you as well as your practice. Now, one of the big things that I get sometimes when I suggest these plans is setting up 401k and profit sharing, cash balance plan. They come with a lot of administrative costs because these are not off-the-shelf plans like a simple plan or a SEP plan. These are custom designed plans where you need to get a plan actuary involved, and there's a lot of legal documents that have to be drafted. You have to do plan amendments. It really is a lot of work. So typically it could cost you easily $6,000 or $7,000 per year, maybe even more, in administrative costs that you pay, by the way, not to me, but to a plan administrator, a plan actuary to set up and monitor these plans for you. Some people get turned off by that, but I'm going to tell you why you shouldn't get turned off by that. Because another important rule is that any money that's contributed by the employer, for example, the $240,000, let's keep the math simple, but let's assume you contributed $240,000 to a cash balance plan. The money that you put in there will forever avoid paying Medicare tax and Social Security tax. The other thing a lot of people don't realize is that when you pull that money out in retirement, that 3.8% Medicare tax, that came under I think they call it the Obamacare tax, that 3.8% tax does not apply to distributions from a retirement plan. That is tremendous because, again, just with a $200,000 contribution, you're going to save basically 3.8% of that. That should easily cover any cost of administration for the plan. And that is not just tax deferral, that's a permanent tax savings. Terrific tool to use. If you qualify for this, I would strongly recommend that you take advantage of it. If your investment advisor or tax advisor is not familiar with these strategies, again, during that call that you're going to have with me, just ask me some questions. I'll help you answer them. If you need further guidance to implement it, I could definitely help you and steer you in the right direction. But very, very powerful tool here, especially, like I said, if you're an older dentist who has not done a good job of saving for retirement, at least not up until now. Okay, so we're going to turn now to tax planning strategy number 7. And I have to admit, the topics that I just covered was kind of intense. The next 2 topics are going to be pretty intense as well, but they are such powerful tools. So I hope that you pay close attention, take some notes, and like I said, call me if you have questions, which I'm sure you're going to have questions. So let's talk about 1031 exchanges. I'm going to read the slide to you. Section 1031 of the Internal Revenue Code provides an effective strategy for deferring capital gains tax that may arise from the sale of business or investment real estate property. By exchanging real property for like-kind real estate, real property owner may defer taxes and use the proceeds to purchase replacement business or investment property. Like-kind real property includes business and investment real property. So by business, we mean business real estate and investment real estate. It does not include your personal home. 1031 exchange, extremely powerful tool. So let's assume for a minute you sell your dental practice, but you still own the office building and you decide you're going to collect rent on that property. There may come a time that you don't want to own that rental property anymore. Maybe you're concerned that the neighborhood that you were in when you were working is going downhill. Maybe you're concerned that the dentist that you sold the practice to doesn't know what they're doing and they're driving the practice down and they're going to struggle paying rent. So utilizing a 1031 exchange would allow you to sell your property, your office building or multifamily home, any investment type property. You could sell it, and even if you have a tremendous gain on that property, you're not going to pay taxes on it as long as you use that money, the amount you sold it for or more, to invest in a replacement investment property. So very, very powerful tool, and I'm going to go through some of the rules that relate to that. From an estate planning point of view, 1031 exchanges are also terrific tools because what happens is as long as you do a 1031 exchange, you'll avoid paying the capital gains tax on the sale of your dental practice office building. Then eventually that replacement property that you bought, you'll continue to own that as long as you own it through death and then you pass away down the road. Once your children inherit that property from you, not only have you deferred the tax, but that deferred tax now becomes tax-free because once you pass away, they can't get you for that capital gains tax. And here's the kicker. Your children, their cost basis, based on the current tax laws, goes up to the fair market value of that property as of the date of your death. So if your children were to sell the property the day after your death, they wouldn't pay a penny of capital gains tax either. So this strategy could actually allow you to permanently eliminate the capital gains tax on the sale of your property. That could be a game changer, especially if your investment real estate is one of your major investment assets. So this is the cover of my book, Financial Independence, Getting to Point X. I would highly recommend that you pick up a copy of it. It could be ordered through Amazon.com or Barnes & Noble. The book is loaded with useful financial planning tips. In addition to that, the second version, which is the green covered book, has a new chapter dedicated to dental practices and the specific strategies you could use to save more of what you make. So with that said, once again, thank you for attending the presentation. I'd like to wish each of you the very best of success. Have a great day and enjoy.